What's going on, guys? And today we got Jerome Powell with his stranglehold over the stock market, or really any market right now, whether it be stocks or crypto or real estate, even right now. So every market is really listening to Jerome Powell. If he says something good, prices go up. If he says something bad, prices go down, which kind of sucks because that means we have to deal with his meeting being the kind of focal point of the market every month or every other month. So it sucks to kind of have to lean on that, and depends on whatever he says. Could be a coin flip how the market reacts. Not exactly ideal for markets, but he did just recently have a meeting where he talked, and we know what happened from that. Markets fell. And some of the points from his meeting was right here. You can see he warned of pain ahead to fight inflation. That was the big topic of discussion, was fighting inflation. Jerome Powell on Friday pledged that the central bank will use our tools forcefully to attack inflation that is still running near its highest levels in more than 40 years. So much stronger language this time around. So the market was kind of expecting maybe it would be less hawkish from the Fed because inflation might have peaked, and the last CPI report we had was lower. It was still like 8.5%. It was still ridiculous, but it was lower than the previous one. People thought inflation might have peaked, and then everything can go back to normal. But that's just not the case right now. We have Jerome Powell coming out saying it's got to get down to 2%, and they are hawking on that and super focusing to get it down to 2%. And if they have to crash the economy doing it, then they're probably going to do that. So even this describing it says Federal Reserve Chairman Jerome Powell delivered a stern commitment Friday to halting inflation, warning that he expects the central bank to continue raising interest rates in a way that will cause some pain to the US economy. Now, that could be important because we know Jerome Powell and the Fed, how they've been talking when inflation used to be transitory, and now they've worked their way all the way up to now we might have to do some pain. So, what does that mean? Does it actually mean some pain, or does it mean drive the economy deeper into this recession and absolutely crumble things to get inflation down and then hope you can get back on the other side? It seems maybe sugarcoats it even up front where inflation was transitory, then it became a problem. Now dealing with inflation was we got a soft landing coming, and now we got a problem. So how much deeper is this going to go? It's definitely, inflation, and solving this is not an easy kind of thing to do once we're in this situation already, and I definitely wouldn't want to be in his shoes. And even with a series of 4 consecutive interest rates increases totaling 2.25 percentage points, Powell said this is no place to stop or pause. Rates are probably around an area considered neither stimulative nor restrictive. So we're kind of in this zone right now where people in the market and the experts say it's not stimulating the economy, but it's not restricting the economy. So, you're in this zone where economically could be good, could allow the economy not to explode like it did with stimulus and stuff and really get ramped up. But it could also make it so it's not collapsing, so people don't really get hurt. But in that situation, what do you do? Because you need it to kind of collapse so people stop spending money, so inflation goes down and the costs of products can start to come down. And two charts are looking at consumer price index, which is CPI, and the personal consumer expenditures price. We can see this stuff right here, the PCE, excluding food and energy, which is kind of weird because you have to buy food and energy. You can't live without that, but this is more sticky inflation, harder to get rid of because it's stuff that isn't volatile, like energy, oil, food. Those are volatile. Those go up and down depending on kind of the economy and stuff. But you can see right here, we have massive spikes up, even sitting at levels that would be similar to around the 80s. So it's not a great look. We've seen kind of constant down here, and then a plunge from obviously 2020 stimulus and a rally up to the 80s levels, and we're sustaining up there. So costs are going up for sticky inflation. You can see this is it, sticky price consumer. So this is the CPI, this is PCE. There's a lot of kind of similarities between them, but they're a little bit different. And you can see this even spiking up here again to levels that are even, this is actually higher than the 80s by a decent amount right here. So it's still about early 80s. I mean, this is a lot higher, but early 80s into the 80s. So both ranges are into the 80s here. They're not good. They're both high. Costs are going up, and trying to control that is not easy and not going to be fun. And he does address that kind of it not being fun right here, saying, of course, inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. So that is people's expectations. Ideally, what the Fed wants to do and what Jerome Powell would want to do is get you to be worried enough to stop spending money, and then they don't have to raise interest rates or do anything. But if they can't do that, and they haven't been able to do that, they've been pounding their fist for a long time now, saying, things are bad. We're going to go insanely hard. We're going to destroy demand. But they've gone very slow on raising interest rates. They want people to be scared, to stop spending money, which will snowball into inflation coming down without them needing to up the interest rates and needing to kind of really, really suffer markets. Because right now and for the while, we've had people that, if you expect inflation to keep going up and you expect high inflation, then you're going to spend your money now, which becomes a self-fulfilling prophecy. With everybody having high demand, supply is low, prices have to go up. You cause more inflation by expecting higher inflation. So you can make high inflation happen just by thinking that there's going to be high inflation. That's what the Fed's trying to do right now. Make people stop spending money so that inflation can go down, scare everyone enough, scare markets enough so that they don't actually have to raise the rates. And talking about the rates, this is the federal funds rate. You can see we've been on a trend for a long time. This is since the 80s. So everything has to do with the 80s, but we have this peak up here, and every single time we haven't gone past this original peak. So this peaked up here, and then you see it coming down and bigger up here. We have a smaller spike. I guess you could say it broke here, but even starting at 86, it's a peak, and then you have it going down, and it doesn't get above where it was last time. Hovering here, you got dot-com bubble, bring it down for stimulus, and when it's coming up, it doesn't get back to where it was before. Very close, didn't go above it. And then again, you got 2008 all the way down, and then rode this out for a long time, started making it back up, didn't get anywhere near where it was before, and cutting it again. And now we are actually on the verge of breaking that. We are basically at the same levels we were in 2019 with these rates, 2.33, and this is 2.4. So we're really right there. And the question is, what breaks if you break this pattern? Does something break? And does something bad happen? Because obviously hasn't been broken for a long, long time, multiple decades. And now we're looking at something where we might actually be breaking this downtrend. And what does that mean for markets, for the economy, for everything going on? It's just very complicated stuff. But that's for the stock market. Have been obviously in a downward market for a while now, since December 30th, around there, or even December 31st is around literally the peak here. And then we've just been going down. But we thought recently, because you can see selling off into a little rally, and that just went into a sell-off, and then this is a big rally. This section here might be what we're looking at, because you see this rally in the middle. This actually broke, it got higher, but ended off in a major sell-off down here into another rally to a major sell-off, and we have this rally right here where we broke the previous little rally, but not this one. So are we looking at a similar situation here where we're going to see this rally be like a bear trap or bull trap, and making it so that people think, okay, we're good, the market's getting better, everything's doing well, and then we're just going to collapse again to even lower lows. No one knows what's going to happen. I don't know if that's going to happen. I feel like the market has a lot of this stuff kind of priced in, high probability of these higher interest rate things, and they are preparing for the worst. So the odds of it really falling all the way back down may be low, but definitely not impossible. I mean, you can just see how red the market has been. Just everything getting decimated, demolished, falling hard, and just not happy with what's really going on. But Jerome Powell seems to have a strangle on the market, on every single market. He seems to have basically control the prices. Good news goes up, bad news goes down. And we're just kind of been rinse and repeating that entire thing for months now. And eventually we got to break away from it, but that time is not now. That's gonna do it for this video, guys. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next